Amazing best annuity product, okay? Going to give great return, probably an amazing low fee fixed annuity, okay?
Sure.
That or Buffered ETF? Go.
Buffered ETFs all day.
So there we go.
So these aren't new.
They're not.
No, 2018 is when they first came in.
Oh, that's still new in the old financial world. So that's new.
2018, they have grown to be about 420 different products, and about $58 billion is invested in them right now.
So your client in this case, Sally Smith, she cannot handle volatility in the stock market.
Right.
Like if she had $100,000 in this Buffered ETF, she still has $100,000.
Correct.
That's
The return never goes negative.
okay.
But there's a cap on the upside. That cap is renegotiated every year.
Oh,
Can I blow your mind some more?
yeah.
When I am looking at these products, they issue a new one every single month. The strategy is if you're nearing retirement, have you ever thought of if you get to retirement and your portfolio drops 20%, is there something you could have done? The answer is yes. We're the nerds. We're going to take you through what you could have done. It's called a Buffered ETF. Welcome back to another episode of Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend. And today we are talking about Buffered ETFs. If you've never heard of them, you're going to hear about them now. And you're going to be a nerd just like us. Congratulations. So without much further ado, let's dive in.
All right, Dave, let's warn our audience again. This is Finance 2.0, all right?
This might be 4.
This might be 4.0. And we're going to try not to nerd out too much. This isn't really talked about a lot. Buffered ETFs?
Yeah. So let's give the definition first. Let's lay the groundwork.
Yes.
So a buffered ETF, that's the slang word. It's called a defined outcome ETF.
Oh.
Did you know that?
No, I did not.
Oh, learning you something today,
Okay,
girl.
Defined outcome ETF.
Yes.
If someone doesn't know what an ETF is, they're already lost.
That's 101.
Yeah, fair.
That's not
fair.
our class
Yes,
today.
Yeah.
So a buffered ETF, if you want to track the S&P 500 and you don't want the downside risk that allows you to, that opens up to, you can buy a buffered ETF. And what that does is it protects the downside, but it also gives you some of the upside as well, getting some of the return in that index. If that's all you needed to know, that's it. But we're going to dive into the weeds.
Yeah, we're going to tell you when we think it makes sense, when we bring them into the plans. This is not for everyone.
It is not.
And if you are listening and you are a 20 or 30-year-old, I probably would not have you in this if you're still growing your wealth.
I think my youngest person who has this is probably close to 60.
Yeah, so let's start with that, okay?
Yeah. So these aren't new.
They're not.
No, 2018 is when they first came in.
Oh, that's still new in the old financial world. So that's new. I mean, not brand new, but it's newer.
So 2018, they have grown to be about 420 different products, and about $58 billion is invested in them right now.
Okay.
So this isn't a small section of the market. It's growing, and it's just reiterating year after year.
Why I still consider that new is we have to give it time when a new product comes out to see how it works too. You know, I never see this new product and I'm like, ooh, I'm just going to be the first one to put my clients in it.
Right.
Yeah. So I said new. Let's go with new. What else do you want people to know?
Well, I think people look at them and say, okay, so this will protect all my downside, and I just pay a little bit more money for it, and then it's gravy. Not quite like that. You do get some downside. You got to be very cognizant of what type of product you pick, but then it also caps how much return you can get on the upside. So you've got to be aware of a number of different factors when you're deciding to choose which product to use.
Okay.
And we'll go into the different types, but
should we explain how it's done, or do you think it's too nerdy? Do you think that everyone is just going to be like, Dave, Heather, you took us down a rabbit hole. What are we going to talk about puts and calls?
We kind of have to, because that's how they're designed, but I definitely don't want to go into the weeds of calls and puts.
I think we should give an example of, like, I was thinking about this as we were writing our episode brief, is let's just give it on a $100 share of stock.
Okay.
ABC stock. We're going to do it on ABC, fake stock, $100 a share. Call and put. Let's talk it through together. Okay. So buffered ETFs use a calls and puts, right? So calls are, you are reserving to buy a stock at a fixed price. So I am reserving to buy ABC stock at $100.
Okay.
Right? With me so far? Okay. And then a put is you're providing insurance to sell at a fixed price. So I get to sell it no matter what happens at $100 a share. Okay. So obviously you can say in the moment of time whether the call or put could be good, right? Like if it's $150 a share right now, the call or put could be good or bad depending on where the stock goes.
Okay.
Are you with me? Is that too much?
I fear we've lost 75% of people, but that's okay. We gave them fair warning.
Okay. So if the stock is at $100 and you buy a call, so a call is you get to buy it at the fixed price, right?
So I reserve the right to buy it at $100 regardless of how high it goes.
Exactly. So that could be very great, right?
Yeah. But I've got to buy that option. So I'm spending some money to get that option to buy it at that fixed price.
Yes. Okay. And then a put lets you sell it at the $100 later. With regard wherever the price is right now.
So I get the insurance on the downside.
Yes.
If it's at $100 now, I buy the insurance to say I can sell it at $100 regardless of if it goes to $4.
And if it goes up, you just lose the fee that you
lose the money that you paid for it.
Okay. So basically what they're using are calls and puts in this buffered ETF that's the mechanisms that they are using to you not to have the downside risk. And I think that we wanted to just explain how this is working. It's not some fake, weird insurance. Like the calls and puts, people use them. They are real. And that's what is being used to put in this buffered risk, we'll call it.
So then if you take that one step further and say, okay, well, how does that translate into the product itself that's being sold to consumers? Well, then it comes across as, okay, how much insurance do you want to buy on the downside? And how much do you want upside to be? Because if you want a really small margin and you don't really care about upside, you can buy a lot of protection on the downside. If you don't care about if the S&P 500 loses a bunch and you're okay stomaching that, but you want a big upside, you can get that as well. So there's so many different products that you can look at and say, okay, I need to understand how much risk I want to take here, and I can find that product that relates to that.
Okay, so let's talk through with our listeners. Well, first, I'm just going to get to a headline right now. Dave uses these. I do not right now because I've not found the use case. So do you use the same product every time, like the same buffered ETF, or do you use different ones? Like give an example of, okay, I've seen one product provide this much downside risk versus this one might only provide this much down and up. I think people want to hear, like, how do these actually work? How much protection am I getting?
Okay. So I will take you through two that I look at and determine if they're appropriate for people.
Okay.
So one is very risk averse. So it's essentially saying, okay, I don't want any downside at all.
So your client in this case, whoever we're talking about, Sally Smith, she cannot handle volatility in the stock market.
Right.
Okay.
So we use 100% protection on the downside.
So
if the S&P 500 goes down a negative point, she's still at zero.
Well, zero. Like if she had $100,000 in this buffered ETF, she still has $100,000.
Correct.
The
return never goes negative.
Okay.
But there's a cap on the upside. That cap is renegotiated every year.
Oh.
But it has to be for a 12-month period.
Got it.
So the cap is usually between 6 and 7%.
Okay.
That cap can go higher if you choose to take more risk on the downside.
Makes sense.
So it's almost like how much risk you want to take on the downside will give you that much more benefit on the upside.
And you and I started talking about this. So let's say for our retirees, I feel like they can stomach 5 to 10%. It's when it starts being like 20, 30% down, 40% down, that people really feel that. 5 to 10 is kind of normal actually in a year. Let's just face it, right? So is it that you protect 15%? So it would go to 85, or it wouldn't go to, if you had 100,000, it wouldn't go to 85 if it went down 15%. But then anything over 15%, it would start going down if you bought 15% of protection, I'm saying.
That's where it comes to be buffered. So that's, what buffer am I buying? So if you buy a 10% buffer, that means that if the market goes negative 10, you're still protected.
You're still at your 100,000.
Yes. If it goes negative 12, you're only experiencing -2 because you've got that 10% buffer. You can buy bigger buffers. So you've got 0, you could buy 10, you could buy 15, you could buy 20. It could be whatever you want to. It just depends on how much risk you want to take.
Okay, so client 1, Sally Smith, no, she cannot experience a loss now, basically, with this. What is her cap, though? Is it lower?
It's probably between 6 and 7% from what I've seen.
Okay, now what's your second client?
So let's say that Joe Sample comes in the door and he's like, I'm okay with risk.
Okay.
But I'm nervous if there's a huge downturn.
Okay.
Like that's going to set me back a long time and I can't come back from that. But I need to get some return in the long term. So that's where it's okay. Sally couldn't take a risk. She couldn't stomach it. So now we're looking at a product which has a bigger upside, but can stomach some downside. So that may be a 15% buffer. With a 15% buffer, then it's obviously more than 7% capped return. It gets to be 11, 12%. Does the S&P 500 do more than 12% in a year? Some years, yeah. But you're not going to participate in that because you're buying the insurance on the downside.
And I think that that's what's hard for people to understand is, that, all over social media, it's, advertised 10% average returns in the stock market. Let's be clear. That is average. That's not how the stock market works. It's actually all over the place. It's not 10, 10, 10, 10. It's like -20, 30 that year, up 40 the next year, down 7, up 14, right? So like you are going to cap returns in this way because it's not an even 10. So I think people are like, oh, it's only capped at 6 or 7. So I'm only giving up 2 or 3% of returns to have a buffered downside. That's not in reality probably how much you're cutting your returns.
It's been a hard product to use in the last 3 years because the stock market has been 20, 25, 15, all over the place. There hasn't been a negative return yet.
I mean, there has for a point of time.
Sure. On an annualized basis, there has not been a negative return yet.
Yes.
So it's become something where it's just been that continued conversation of this is prudent still. And also, if we're looking at your financial plan in the big picture, do you need 20% returns? Most likely, you probably need 7 to 9% returns. We're still getting that. But you've got the insurance on the downside when that time comes.
Yeah. But it's not 7 to 9 every year, right? Because if, let's say, the stock market is down 20%, you're not getting your 7 to 9%. You would just get 0, or if you bought 15, you'd just only be losing 5%, right? So it's only 7 to 9 on the years that the returns in the stock market are that high.
Exactly. If the stock market does 1%, you'll also do 1%.
Exactly.
So you have to be aware of in those bands where it's the same as the stock market, you'll just mirror that. Your fees will be a little bit more expensive because you have to buy that insurance as well. So you probably won't net what everyone else is getting, but it's very similar.
I mean, I think this is an amazing product for people that cannot stomach volatility.
Yeah. Well, let me tell you the way I use it, because the way I'm using it is it's not as drastic as that. So I am going into people's meetings with them, and they're all retirees. I don't use it with pre-retirees. And we're essentially saying, okay, the S&P has been really volatile on the upside for the last 3 years. That's been wonderful for your portfolio. If it's volatile that way, it can go volatile the other way. There's nothing saying that it's going to go up forever. So let's be a little protective here. Let's split, and I only use it for S&P 500 allocations at this point.
Okay.
Let's split your S&P 500 allocation in half. Let's leave half of it alone and just let it ride. Let's do what the stock market does. Let's put the other half in a 0% floor buffer where you'll never get a negative return, but you'll get capped on the upside. So you may get 7%. So then people are like, well, why? Okay, one, the volatility of that portion of your portfolio is brought way down. And if we are seeing volatility of 20% returns, that's fluctuating a lot. If it goes negative, you'll experience negative returns on 50% of your portfolio, 0% on the other half. If the return is positive, you'll get all the positive on one half of your portfolio and the majority of the positive in another part of your portfolio. So the upside, you're probably going to get 75% of the returns on the upside. The downside, 50%. So when people look at it that way, saying, okay, so I'm getting most of the gain on the upside, but only half of the down of the negative years, I'm okay with that. Like, great. Then we'll move forward.
I still look at it differently than you because I'm like, well, not like the years that are 20, you've cut it in half. And then the years that are negative, you won't have the returns. So I think like, I don't know if it'd be 50%. I think when we were talking about this, I think you put it in the best way. It's like if you're, because I was like, you'd have to model this correctly, right, in your financial planning software. And so it's like if you expect the stock market to return 10%, you then model this half of the portfolio is only going to return 5%, like half, which I think that's what you told me you were doing, right? Yeah. So again, this is probably not for the people that don't have advisors or the DIYers, but I mean, Dave and I want to share with people that there are options for everyone out there. If you can't stomach the volatility, or one of your biggest fears is, I don't want to run out of money, so I'm not enjoying it in retirement. Like, these are great options for those people.
It is. I think a lot of people get stuck on the fact of, well, I don't want zero negative returns and a really small capped upside. Like, then don't choose that.
Yeah,
choose another product in here.
Yeah, I would not.
There's so much variability that you can choose.
I would not be a good client for this retirement age.
You're also not 40 yet. That's probably, you're not the ideal client at this point. The ideal client is...
But I'm saying when I'm retired, I don't think I would use these because I understand the stock market. The volatility doesn't bother me as much as I think people who, it's just a different risk tolerance that people have. There's another place I think these are better instead of using another product.
Well, the question I get is, you just explained an annuity.
Exactly. That's where I was going to go. And so, you know how we do rapid fire, Dave? Amazing best annuity product, okay? Going to give great return. Probably an amazing low fee fixed annuity, okay?
Sure.
That or buffered ETF? Go.
Buffered ETFs all day.
So there we go.
The reason that I say that is I then turn it around to someone and say, can you sell your annuity tomorrow and be liquid? And they're like, no, I'm locked in for life. I'm like, I can sell a buffered annuity tomorrow if we don't like it.
And I think that is a very key difference. And every time I brought up annuities, before these are starting to be more known, I need products to be in the, like now that we've kind of had the 2022 inflation temper tantrum of the stock market and the tariff temper tantrum, we haven't had a huge downturn since these products have come out, but we've had a few, well, I guess we also had COVID.
We did. We actually saw it worked really well this year because the market did fine in January, February. It had a temper tantrum in March, and then it soared in April. What you saw in the S&P 500 was a lot of volatility. It did great. It really didn't do well. And then it did amazing again. And then it got into positive territory. Buffered ETFs, there was no volatility there. It tracked up. It never went negative. And then it started tracking up again. Did you get all the returns of the S&P 500? No. But you also didn't get negative. So it's...
I think if these are explained really well and it is someone that you are considering an annuity for, you should have the discussion. And every time I bring up to my clients an annuity, they're like, no, I don't trust an insurance company. I don't want it locked up. Like those are the reasons I get. And I agree with them. I mean, you pay a fee. This is a good like I would prefer that over an annuity. Yeah.
The thing where it doesn't beat an annuity is when you say, well, does it guarantee me income for life? Well, it's an investment product. It will not do that at all. No investment product does that. That's an insurance product.
Yes. If an S&P goes to zero, I'm guessing this thing is gone. What are you calling and putting?
So it's, I'm not going to guarantee that because I can't. But also, how much are you paying for that? So yes, you've got guaranteed income for life. Are you paying 3% a year to have that guarantee? And is that worth it to you? Some people, yes. That's a key thing that they're looking for. Other people, if they're just looking for that protection on the downside, which an annuity offers, but they want to stay liquid, an annuity doesn't work. This does work for them, and it still gets them the protection they're looking for.
So you're modeling in your plans like a different return projection and all of that so these plans, I was thinking about this for you. I was like, these are complicated to run with a buffered ETF. Because how do you do that? Like in our financial planning software, we like basically project out the returns, but you're like, nope, I guess you would probably change the asset allocation in there to say like some of it's bond or something.
When you're looking at a 30-year projection, it's going to wash out because you're not going to get the negative returns, but you're also not going to go as high on the positive returns.
Okay, that makes sense.
So it kind of washes out when you're looking at it on a long period of time. If you look at it from a shorter period of time, it's probably like an aggressive bond. you've got the downside protection, but you're capped on the upside of maybe 4, maybe 5% per year. So yes, it's going to be more conservative, but it's also only a fraction of the portfolio. I really use it just to tap volatility and just keep it in its place, because people, they struggle with that when they get to retirement.
Well, the retirees that are listening to this that are terrified of the stock market just probably got a little excited.
Yeah. And they're a lot cheaper than an annuity.
What is the cost on these, would you say? And like, to give the audience, I would say, would you not say the typical price or like expense ratio on an index fund, S&P index fund, is like 5 to 10 bips? So like 5 to 10% of 100%.
0.05.
Yeah. So,
yes.
So what is the expense ratio on a buffered ETF?
So it's roughly 0.8.
That's 0.
Not 0.08, 0.8.
So 80 bips, in my word. So like 80% of 1%. So, yeah.
So it's probably cheaper than your typical active mutual fund.
Yeah.
It's definitely more expensive than a passive mutual fund. But then when you look at it, you're also buying protection on the downside. Mm-hmm. That costs something.
Yeah. Understandably so.
It's not going to be, it's not crazy expensive. I think that's the part I like about it. It's under 1%. And that, when you look at the investing world, anything above 1% is considered pretty expensive these days. Mm-hmm. And you would expect a lot from it. And this, you actually do get stuff with it, and you're paying for it.
Okay, that's great. Okay, I don't think I have any more questions on buffered ETFs. And I wonder how our audience did.
Wake up.
Again, Finance 2.0. Dun, dun, dun. All right. Is that everything you wanted to review on them?
I think when people are DIYing their financial plan, this will be my last point, I would be hesitant to have someone just buy a buffered ETF, because there is a lot that goes into the decision making of how much money do you put into it, what type of product you're using, when does it get refreshed. There are more and more products coming out where they are looking, sorry to get nerdy, they're looking like long short funds now, where you can get dual direction buffered ETFs.
Interesting.
So they're getting very technical. And if you buy the wrong one at the wrong time, it can mess up your allocation and your plan.
Well, I was thinking just on product alone. I mean, you look at an S&P 500 index fund, and if you're buying it from some insurance company out there, I won't give some names, but you're going to find it very expensive unnecessarily versus like Vanguard or Schwab or, BlackRock or something. So I think what product and who you're buying it from really matters too. So I think to help our audience with this, I think the questions will probably be good.
I think so. I'm sure some people are like, huh? What? It's been 20 minutes. What are you talking about? But if that's not you, if you've learned something, we need something from you. So that's going to be a like, a comment, subscribe, a follow. You're also going to send this to your nerdy finance friend, and he's going to shoot back and say, what they said is complete trash. Don't believe it. But you know to believe it.
Dun, dun, dun.
Do you have a bow for this?
My bow is, this is not for the young who are still building wealth, asset accumulators. Okay, this is for, you are now in the place in your life where you are going to live off your portfolio. You need some upside, but you are terrified of volatility to the point that you aren't enjoying your money. Consider one of these products, talk to a professional about it. But if it is going to make you feel better about your money and enjoy it, this is probably a good option that should be considered for you in your portfolio. How was the bow?
Fantastic. All right, moving on to the next section. It is our question section. It is called, What Would You Do? All right, question number 1. I'm about to enter retirement, and I'm worried about what happens if the stock market drops in the next 6 months. How can I protect myself?
Well, I mean, go back to our buckets episode.
Come closer. Let me tell you about buckets.
Buckets. I do love the buckets. Which one is that? Retirement income. What did we call it?
When do we mention buckets? Episode X, Y, Z, 1,
I mean,
2,
every
7,
episode.
all of them.
But there is I think there's an episode where we call it designing your retirement income or something like that. I forget what number. I'm not that good. But go back and listen to that one. Buckets. Normally that is what makes my clients feel the best, having 1 to 2 to 3 years of their living expenses in cash, and then somewhere between 4 to 7 in fixed income, bonds. That's normally enough. But if you are still nervous Nelly or nervous Ned, then maybe you need to consider a buffered ETF.
Good answer.
There was one question I didn't ask you about these.
Mm-hmm.
Okay, your clients with buffered ETFs.
Mm-hmm.
Back to one of our favorite terms. We should have alcohol at some point and take a shot every time we mention buckets. It would not go well. All right.
We'd be on the floor.
Or we'd be on the floor. But do you adjust your buckets if you use buffered ETFs?
No.
Interesting.
This is a volatility play for me.
I know, but I also use the buckets for the volatility, right? So when volatility is going on, stock market's down, I'm tapping into the cash and fixed income, not the stock. But you're also not having as much volatility. So I'm like, your buckets could probably be on the lower end of I guess it depends, of course, on how conservative Sally Smith is. I understand. Sally Smith seems very, very conservative.
Yeah, I think it does depend on how much cash they feel comfortable with. I'm also still treating this as it's still an S&P 500 allocation to this. So there's still going to be returns. There may not be negative returns. There are going to be some positive. And so I'm not really adjusting too much. It's just you're not going to see your portfolio jump around as much.
Okay. All right. Question 2. I've been talking to my insurance broker. Oh boy. And they have been talking about a fixed index annuity for 401k. They said they can roll my 401k to this annuity. I get a floor on my market returns and guaranteed income for life. What do you think? Oh, Dave, take this away.
All right. So you mentioned a lot of stuff in there. Yes, you get guaranteed returns for life. That is a extra optional add-on you can put in your annuity. It's going to cost you some money. And you get a floor on your market returns. Mm-hmm. That's part of an annuity product in of itself. It's part of the cost. So yeah, you're going to get all of that. I think the important part is going to be, how much does it cost me across my entire lifetime? Granted, it's going to be probably between 1.5% and 3.5% to get all of those products. And then you say, well, if I'm not too concerned about the guaranteed income for life, like I think my portfolio can sustain that, well, why would you pay 3% for things like that when you could get it for a third of the price and still get the same features? Like, it doesn't really make any sense. To unwind an annuity is expensive.
Oh, the surrender charges. That's the thing.
It's not easy to do.
We both have clients in financial freedom. Having my clients locked up in annuities would be sad to me right now when I see how they're enjoying their money and like going on this trip or getting this car or all of these things. If you're in an annuity, it's like, okay, we got to budget and figure out when we finally have as much saved, like you don't have the liquidity. You've locked yourself in. Yeah. And this is where I went on my soapbox. I got a little upset reading this question. Yeah. Why an annuity and a 401k? One of the advantages of annuity is tax deferred growth. I mean, that's what they sell. Well, 401k is already tax deferred. What? Why?
The annuity and the IRA blows my mind sometimes. It's like, let's hide something inside something that already does the something that we're looking for.
I just want to say, oh, geez, no. Please go talk to a professional. This is what I want to say. Please talk to a professional. Like, I don't care if you pay for hourly advice. But just get from a fee-only fiduciary financial planner or advisor before you go buy that annuity. Mm-hmm.
When someone says they got advice from their insurance agent,
no.
What product did they offer you?
Please no. All right. I've been doing some research on buffered ETFs already, and there are a lot of products. How do I pick the best one for me? You're definitely the one to answer this.
There are a lot of products. There's a lot of companies offering them too. When that happens, a lot of that looks different, but it's actually the same. So for example, I use a product called Innovator ETFs. It's run by Goldman Sachs. The reason I use them is it's very transparent. Mm-hmm. They tell you the fee that they are going to charge you up front. It's all on their website. It's through all their emails that they give you, and they will tell you the cap that's going to be for the next year, and they'll tell you the downside it's going to be for the next year and what date it renews, and they just consistently update you. Do other companies do that? Probably as well. But I have found that the people that I work with over at Innovator are just very open, because I will email them what could be construed as a stupid question, but they just give back very straightforward answers.
I like that.
So it's easy to work for there. All right, so how do you pick the best product? So let's say you've chosen a company. Let's, for argument's sake, said, okay, you're going to go with Innovator ETFs. Well, what type of protection are you looking for? Mm-hmm. Do you want something where there's 0% chance that you're going to lose money.
Well, and how much market cap can you have? Like how much returns do you need in your portfolio to live too?
Yeah. So there's some variables.
Yes.
Like if you need 12% per year, well, your plan's probably not built right.
I was like,
you're not going to do well
what
here.
is your retirement probability of success? 30?
So if you need that, you're probably not going to pick a product that only caps you out at 7.
Yeah.
Granted, your whole plan is probably going to fall apart anyway, but it doesn't matter.
Yes.
But if you're also looking and saying, okay, and this is more probable, if I go through a downturn of 30% that doesn't recover quick enough, if my plan then falls apart then you need something which doesn't expose you to that. You need something that gives you the buffer of 0, 5, 10%. So you want to make sure that it's not really the upside that really affects people, it's the downside.
You know what, another question that's coming to my mind, I always have questions. Mm-hmm. On the market cap, you said something interesting that they adjust it every year. Mm-hmm. So I am curious when there's another 2008 type of downturn or .com bubble, is that it goes down 30% and then they cap it. Like, is there like with ARMs, the rates on mortgages where like they can't increase the interest rate after a certain amount in a year? Like, can they only go down so much in a year? Do you know?
Can I blow your mind some more?
Yeah.
When I am looking at these products, they issue a new one every single month. So the strategy is if the market has gone up and I've used a lot of my cap already, mm-hmm. I can sell that product and buy next month's and refresh the cap that I'm allowed to use.
Capital gains you're recognizing?
Sure.
Yeah.
But if it's a case of, okay, I've got 7%, now can I sell that and get another 7% on top of that?
Oh, I wonder if they're going to catch on.
That would be great.
Yeah.
And that's the strategy that they talk about. They talk about it on the downside too, of if the market has gone down 20 and you're in a 0% buffer, we'll reset your buffer. Would you want to do that? Maybe it works, maybe it doesn't. These are all the strategies that mm-hmm. people are trying to figure out. And if they do that by themselves, it's really hard. Mm-hmm. But there's definitely strategies you can use that if the market is volatile, you can buy in and out of different buffered products because they renew and new ones are made all the time.
I get that. I guess my question is, could you see them capping the return if we're having a really hard downturn? Do they say, we could cap returns at 2% or something like that? So you wouldn't get the rebound of the market, let's say.
Well, the cap is based on the contracts. So the calls and the puts and how expensive they are. Mm-hmm. So that's part of it, what goes in there. Could they say that the cap is going to be 2% on a rebound? Probably not. Because then there's no reason to buy it. Mm-hmm. So there has to be some incentive for people to buy it. But then if there's going to be a rebound, then you'd probably want to say, okay, this is why we use buffered ETFs. If you hit the cap in this product, let's go buy the next product, the next month out, and just keep leveraging up so that we get a new cap. And then you can fully experience the rebound of the market.
Yeah. Okay. I want to see one go through a downturn. I'm excited. All right. I'm sure they have insurance too. I would imagine that they have insurance in case, one of these.
The options don't work the way they're supposed to?
Yeah.
All right. We're going into the last section of our podcast. It is called Highlights. All right, highlights is where we're talking about personal stuff. We had an episode 64,
okay.
where I got excited about it as I did this one and talked about credit card points.
Yes.
Oh, did that light a fire under my butt of, okay, I need to get back in the game. Mm-hmm. So I was talking about flipping cards every 3 months to get the bonuses.
Yeah.
Yeah, I'm back in the game.
You having fun? Because you're out of tax season now, you have some time, so now you're playing around.
I'm trying to get our England vacation for free.
How's it going?
It's working well so far. I have probably 12 months. I think I can probably flip 9 cards in 12 months through my wife, myself, and my business.
I love it. I love it. Okay, well,
if you look at hotels in London, they are ridiculous.
I know. I used to live there.
Yeah.
Keep me posted. I think this works a lot too. On the credit card points, Alex and I have noticed this. Like, we're trying to plan our summer right now, and I'm looking at flights for Europe right now. I'm leaving in like 2 or 3 months. Like, this is not a lot of time to like rack up the miles. Got to I think this works when you're 12 months out.
Sure.
You can really maximize it.
Well, I tried to play the game of, can we make this a really good trip and like put everyone in business class? No. When you look at the price of an economy or even an economy plus seat, going from Chicago to London, and then you compare that to a business class seat, sometimes it can be 4x the price. Mm-hmm. I'm like, yeah, my kids need to stay humble.
I think put the kids in the back and parents ride in business.
My kids will be 17 and 15 at that point, and one is medicated. I am not unleashing that on the rest of the cabin. No. All right. What about you?
All right. I have something funny. I went to the Scottsdale fair.
What type of fair?
Like a fair, like with my kids, where there's dead grass and there's the games and the Ferris wheel.
Okay, yeah.
And the funny rides. Mm-hmm. Corn dogs.
Funnel cake?
Funnel cake.
Yep. Talking to a Midwesterner here. This is like every weekend in the summer.
I know.
Yep.
It's not my thing.
It was going to go one way or the other. Yep.
Like, I tried so hard. I wore tennis shoes. I was prepared, and I was happy. I was a happy mom. I will continue doing these things, but I did not eat dinner there.
That's tempting fate. Yeah, I know.
And I was like, they definitely for kids, but this is not my thing. This is just not my thing.
The one time I remember my dad throwing up is when he got off a ride at the fair. Oh. And he was like, excuse me a second. And I'm like, where did dad go? And like, he's throwing up in a bush. Yeah. So yeah, it's an experience. I thought you were going to say Renaissance fair. Have you been to one of those with the girls yet?
No, but I've been to one in college. Don't ask. Let's.
No? Okay.
That's interesting. Those are interesting. There's a lot of fans for Renaissance. It was shocking.
I haven't taken my boys yet. I want to take them this summer. I mentioned it to Sarah already. And I just want to watch them watch people at the Renaissance fair, because it's just another world.
It is. And people are passionate. I like that though. Mm-hmm. I will say, people that have no passions, that's boring. I like people that are passionate about stuff.
All right. Well, thank you for listening to this episode of Playbook of the Wealthy. If you want to keep listening to us in audio form, we are on every podcast platform. If you want to watch us in video, because look at us, who wouldn't? We're on YouTube, Instagram, Spotify, and Apple Podcasts now that they are doing their video version. If you want to contact us, you got to go to our website first. We are at playbookotw.com, and from there you can email us. We're at hello@playbookotw.com. And we'll see you next time.
Toodles!
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.